Hello and welcome to today's expert webinar presented by AccountantsWorld. Our topic today is Cost Accounting R.I.P. presented by Ron Baker, co-founder of the VeriSage Institute. I want to thank all of you for joining us today. My name is Div Bensali. I'm a vice president at AccountantsWorld. Today is actually our final expert webinar of the year. We've had 16 of these with an incredible range of topics and expertise that's been presented, and we're really proud of what we've been able to help bring to the accounting community this year, and we're looking forward to doing it again next year, starting in April or May as well. I'm also going to mention at the end of today's webinar how you can access all of this year's webinars on demand for free. So I'll give you guys the link to be able to do that as well. But very, very excited to have Ron Baker with us today, and looking forward to getting started there in just a minute. Before we do, just a couple of quick housekeeping tips. In terms of using the GoToWebinar control panel, if you don't see the control panel, look for an orange arrow. That orange arrow expands and hides the panel. If you want to check out your audio options, you can click on the audio tab and then select either computer audio or phone call. If you select the phone icon, it'll give you a dial-in number and an access code there. If you haven't yet downloaded Ron's handouts, you can go to the handouts tab and you'll find Ron Baker presentation under there, so you can follow along and take notes as you're going through this today. And finally, if you have any questions for Ron at any point during the presentation, go ahead and type them in under the questions tab. Make sure to click the send button to ensure that it comes across to us, and Ron will be answering those throughout the presentation. Also wanted to mention, if you look in the bottom left-hand corner, you'll see the expert webinar hashtag. So if you are active on Twitter and you hear anything during the presentation that you think is noteworthy and you'd like to share, or if you'd like to communicate with us, Tom, one of our marketing folks, is going to be live tweeting during the presentation as well. So we can carry on that conversation there and continue to share this with other people there as well. So once again, that hashtag expert webinar. We do offer one CP for today's webinar, and that's based on active participation during the live presentation. Active participation means three things. You attend the live webinar for no less than 15 minutes. You respond to all three of the poll questions today, and then you submit the post-webinar survey. So as soon as you close out of the window after today's presentation, you'll see the GoToWebinar post-webinar survey open up. So just take a minute and fill that out, and then you are good to go. If you don't see it pop up, no worries. We'll send a link to you by email as well following the presentation today. That email usually goes out within the next 24 hours. So just look for that, and then you can go ahead and fill out the survey from there. We'll notify you within 3 business days that your CP has been processed and approved. And please make sure to add webinar@accountantsworld.com to your trusted email list to make sure that any communications from us about today's webinar make it through to you. I also wanted to mention another webinar that we are doing for the next 2 weeks here as we close out this year. Many people who are doing payroll processing are evaluating their payroll processing solution at the end of the year. And we encourage you, if you're not using AccountantsWorld's payroll relief solution yet, to go ahead and check that out. Payroll relief was designed exclusively for accountants. And the key is that it has unprecedented automation, performs payroll processing tasks automatically on time with 100% guaranteed accuracy on computation. And in addition to that unprecedented automation, it also delivers other benefits. Streamlined workflow. The entire sequence of payroll relief is organized to follow the natural sequence of payroll processing, so it's easy to learn and easy to train other people on. And it's fully customizable, so you can customize your payroll service to best meet the needs of each of your clients and exactly what they need and are looking for there. Over 70% of payroll relief customers have cut their processing time by 25% or more, and we've been rated 5 stars by CPA Practice Advisor for 5 years running. So if you'd like to learn more, best way to do that is either to go to our website, accountantsworld.com, and click on payroll relief, or if you'd like to sign up for our free webinar, you can go to improveyourpayroll.com. That webinar will be, we're giving it, I believe, tomorrow and then again next Tuesday as well. So you can sign up for whichever date makes the most sense for your schedule. So once again, that's improveyourpayroll.com. Before I turn things over to Ron Baker, a brief introduction. Ron is the founder of the VeriSage Institute. I was checking out their website earlier this week, and it's really remarkable, the range of content and expertise that they bring to the table at VeriSage. Ron is widely acclaimed as one of the leading authorities on pricing in the knowledge economy. And in addition to being named to Accounting Today's top 100 most influential list and a number of other accolades, he's also been selected to this very exclusive group on LinkedIn called LinkedIn Influencers. And those are people who are having a national or global influence on our economy and on what's happening digitally as well. So without further ado, I'd like to go ahead and turn it over to Ron Baker.
Thank you, Div, and welcome everybody to the Cost Accounting R.I.P. webinar. I'm really looking forward to today. Let me get my screen up here so everybody can see my PowerPoints. I'm hoping everybody can see them now. I want to let you know that this is a difficult and controversial topic. I am a CPA, a recovering CPA. I no longer practice, but I do work with CPA firms, but I'm also a former cost accountant. So what you're about to see is the change in my mind. And changing one's mind on a significant topic isn't easy. I mean, and it doesn't happen in a burning bush moment or in a sudden epiphany on the top of a mountain. It happens by struggling and wrestling with the issue and grappling with it and studying it and going deeper into it. And there's a point that you cross over where you're now on the other side and you see the flaws of the old paradigm. And that's where I am with cost accounting. So I just want to say that I am not here to change your mind. I'm not here to have you think like me on this topic. I am here to have you think with me. And I want to point you to the resources and the arguments that swayed me. I don't expect them to sway you. If your mind can be changed in a 1-hour webinar, your mind's probably not worth changing. I need you to struggle and wrestle with these issues like I did. But one of the things I found when preparing for this presentation was this fantastic line by Amelia Rorty, a philosopher. And she said, the crucial principle for coming to know the truth is namely that our ability to engage in continuous conversation, testing one another, discovering our hidden presuppositions, changing our minds because we have listened to the voices of our fellows. Lunatics also change their minds, but their minds change with the tides of the moon, and not because they have listened, really listened to their friends' questions and objections. Well, I consider everybody on this webinar to be a friend because you're all colleagues. You all work in the accounting space. I know many of you are probably CPAs like me. And I just want to show you some of my objections and questions with respect to cost accounting. So there are 4 books that radically changed my thinking on this topic over a period of about 15 to 20 years, I might add. That's how long I struggled and wrestled with this issue. The first one, I'm sure many of you have read. It's literally a global bestseller, Eli Goldratt, The Goal. Now, when I first read this book decades ago, I had no idea. The cost accounting arguments swept over me. And I don't believe there's many cost accounting arguments in this book, but there is in Goldratt's other body of work. I mean, there are videos you can watch of him online railing against cost accounting. And keep in mind that Goldratt was a physicist, by the way, but it's really important to understand that accountants didn't invent cost accounting. Engineers did. And engineers issued plenty of warnings about it, about its imprecise nature, about its arbitrary assumptions, and to take the data with a grain of salt. Nobody listened to those arguments, especially after our profession got into this space. So Goldratt's work, subsequent, and you have to go online to find some of these things, but you can find his lectures where he talks about some of the problems with cost accounting, because of course this book, The Goal, is his theory of constraints, and the theory of constraints implementation ran up against the barrier of cost accounting. And cost accounting is viewed as this oracle of Delphi, which it is not. And he had a lot of problems. He's actually quite a curmudgeon when it comes to cost accounting. The second book I read that literally blew my mind wide open is a book called Profit Beyond Measure. And the reason is because H. Thomas Johnson is a professor of accounting, I believe at Oregon State University. And he is the father of activity-based costing. And when he was giving a lecture on that, somebody came up to him at the end and said, "Have you ever studied Toyota?" And he said, "No, why?" And the guy said, "Because Toyota has never used cost accounting ever in their entire history, even before they made automobiles." And Johnson was skeptical. He said, "That can't be possible. Toyota is one of the most profitable, one of the most creative, innovative companies. They have a market cap that exceeded the big three at the time." And he didn't believe it. And then he went and studied Toyota. This book is the product of that 4 or 5 year study. And it's literally true that Toyota doesn't use a cost accounting system. Now, this is not to say that Toyota doesn't know its costs. That's absurd. Of course it does. What it says is they don't let cost accounting allocations determine how they organize their work, how they price their vehicles, or any other thing to do with operations. And then in the last couple of years, I ran across, just surreptitiously or actually surreptitiously by chance, Dr. Reginald Thomas Lee, who wrote the book Lies, Damn Lies, and Cost Accounting that you see here. And he just put out, literally it's out within the last couple of days, Strategic Cost Transformation, which is his follow-up to Lies, Damn Lies, about, okay, we've shot down cost accounting in the first book, what replaces it? And I was privileged to write the foreword to this book because I think these 4 books combined that you're looking at on the screen will seriously make you question cost accounting. And I just want to share with you what some of these authors have said and how my thinking has changed, and give you some examples. So here's Dr. Reginald Lee in Lies, Damn Lies, and Cost
Hey,
Accounting. Said,
Ron,
yes,
sorry, do you mind if I just jump in for a second and we can do the first poll question and then come
sure.
right back to this?
Oh, sure, you bet.
All right. So just to get a better sense of who's joining us today, I'm going to go ahead and launch this first poll question. So folks, if you can go ahead and let us know the size of your firm. Are you a sole practitioner, 2 to 5 professional staff, 6 to 10, more than 10, or not in public accounting? And so if folks could go ahead and get their vote in, make sure to click the submit button. Just a reminder, this is the first today of our 3 poll questions. Polling is required in order to earn CPE credit. And so we'll take about 15 seconds more here for people to get their votes in. All right, let's go ahead and close this out in 5 seconds here. Going once, going twice. Okay, great. So 42% sole practitioners, about 20% 2 to 5 professional staff, and then smaller numbers at 6 to 10 or more than 10 staff, 23% not in public accounting as well.
Excellent. All right. Thanks, Dave. Okay, so here's what Dr. Lee says: 3 reasons costing is a bad practice. First, to get a cost, you have to create and force math and relationships that do not exist. This is an incredibly profound insight, and I'm going to try and give you examples of this. But if you're CPAs, you kind of already know this intuitively, and you'll see what I mean. The second reason costing is a bad practice is by doing this, you lose touch with your operations. This is precisely why Toyota doesn't use cost accounting, because they don't want cost accounting to dictate their operations. They let the operations work as best they can in terms of managing the work and the costs that they should put into an automobile. But all that is determined before they build the car. And the third reason is you create meaningless numbers that people consider as gospel, what Lee describes as a single representation of an artificial reality. And I can't tell you how profound that is, too. I mean, people think that cost accounting is precise. And even when I was a practicing cost accountant, I knew it wasn't, because I knew there were different methods of cost accounting that would throw off radically different numbers. But somehow it never registered to me that that's lousy math, and that's not a measurement. A measurement is not the result of a measurement does not change based on your choice, right? And I'll try and describe that difference as well between a measure and a metric. So those are Lee's three arguments of why cost accounting specifically is a bad practice. Here's what H. Thomas Johnson says, and again, this is the father of activity-based costing that Goldratt described as a new way to be wrong. And now I believe that Johnson would totally agree with that. He says, you can use accounting to describe a business's external condition, but it offers little insight into the particular inner relationships that determine those results. He further says, because cost and profit are not objects, but are properties that emerge from relationships, quantitative measures can only describe them. They can't explain them. In other words, a business is an organic, interdependent system like your human body, and you can't bust it apart to understand it, and you certainly can't allocate it down and get a greater understanding of it because it's a system. This was one of the big ideas in the theory of constraints, that some parts of the system need to be less efficient, less optimal for the entire system to work optimally as a whole. So it's integral to systems thinking as well. So there's a lot of disciplines in this talk today, and I can't apologize for it because it's multidisciplinary, just like a business is. There's no single aspect of a business that's more important. It's a system, and they all work together. But basically what Johnson's saying in these two quotes that I've given you is we can audit the drunk's bar bill, but what we accountants or cost accountants can't tell you is why he's an alcoholic, right? Because I'm only showing you, but through the audit of the bar bill, the result. I can't say anything with respect to the process, the relationships, the interdependencies of how the work is processed that create those numbers. And that's essentially Johnson's point. So Div, I know we just did a poll question, but here's where I had the second poll question, if you want to fire that one up.
Sounds great. All right, we'll go ahead and launch that right now. So folks, the question here is, what is the biggest fixed cost that your practice or business has? Select one of the following: rent, employee salaries, utilities, or other. So if you can go ahead and select one of those options, make sure to press the submit button. And just a reminder, this is the second of our 3 polling questions today. Ron, one question I have for you. I know I saw in your bio that you've spoken on this topic all around the world. Are the attitudes towards cost accounting different in the rest of the world, generally speaking, than they are in the United States?
No, cost accounting is pretty universally considered gospel. It's scary. It shows you how powerful the profession has been spreading this nonsense.
All right, we're going to give 5 to 10 more seconds for folks to vote if they have not yet done so. Going once, going twice. Okay, I'm going to close that out. So 63% said employee salaries are their largest fixed cost, 13% for rent, a smaller number for utilities, and then 21% for other as well. So interesting results there. So Ron, I'll go ahead and turn it back over to you here.
All right. Thank you. So let me give you some other thoughts from Dr. Lee. He said costs and profits are not absolute. They change based on the model you use to calculate them. As you all know, there are at least 7 or 10 different types of cost accounting, which I'll show you. the largest expenditure for most companies is capacity, whether it's space, whether it's labor, materials, equipment, technology. Unless you model and manage capacity effectively, you will not achieve the cash flow results that you seek. And since 63% of you said salaries are your biggest fixed cost, and I would expect that. Rent's usually up there too in professional firms, and as is technology. Um, what we really need to model and have a sense of is our capacity, not so much cost allocations. The other thing Dr. Lee does in his most recent book, The Strategic Cost Transformation, is he talks about two domains: the operation and cash domain, which is where he wants you to model cash flow. And that houses all the information. But that information is then taken, cut up, allocated, and turned into the accounting domain. Now, look, I recognize that we need to do that to get inventory valuations and things like that for tax reporting purposes, but I'm not talking about that. I'm talking about running your business and making sound business decisions, not just tax minimization decisions. I realize that we have to do this accounting function for tax purposes, but that's not the purpose of this program. I'm talking about business decisions, which are far more important. The other thing that Reginald points out is there's too much focus on accounting data and not enough on understanding the factors that influence the data. The idea that you can calculate different costs from the same data and information should suggest that costs do not represent cash. I can't tell you how important this point is, that an allocated cost is what he calls a non-cash cost. In other words, it could show up as a cost on the income statement or in an inventory valuation, but it has nothing to do with cash. And cost accounting confuses measurement with metrics. Companies spend millions to manage costs that have nothing to do with money. So let me dive into that point, because I think that's an utterly profound point. This difference between metrics and measurement, and they are not the same thing. Those are totally different words with completely different meanings. So you've seen LIFO and FIFO and average cost inventory methods. This is kind of the same thing. We can use a different inventory method based on assumptions that we're making about the flow of that inventory, last in, first out, first in, first out, or average cost, and there's others. There's NINO. There's all sorts of different assumptions. Now remember that measurements are not based on a choice, right? If you're counting the number of people of walking into your business, you don't get to choose how you're going to measure that, right? So the difference between a measurement and a metric is, if we were to walk outside right now with a thermometer, or even two thermometers, let's say, and let's say they're relatively quality thermometers, we're going to get a real accurate measurement. It's not going to change depending on the thermometer, right? But why is it that net income and also look at the difference here between these methods on net income? How can this be a precise measurement of anything if the number that results is determined by the method, which is really the assumptions that we have about what operations is, right? This is where Lee's point about how this analysis separates you from the operations. What's right? LIFO, FIFO? I mean, what actually happens in the real world in our factory of how we produce work? It, by making assumptions about it as a cost accountant, it doesn't tell me how to fix it in the factory shop floor. And this, of course, is Goldrat's point as well with the theory of constraints. So, and I have found, presenting this around the world, that CPAs can get their head around this. They know the difference between FIFO and LIFO, and different inventory valuation methods can throw off radically different numbers. Well, that's what we mean by a metric. That's not a measurement. And too often, cost accounting is considered a precise measurement, and it's ludicrous. It's a metric, and it's a completely arbitrary metric at that, because these are just some of the different cost accounting methods you can use, right? You can use lean costing. You can use marginal costing, which pricers, I happen to be a pricer, We use marginal costing, if anything, just because we like to make decisions at the margin. But there's also activity-based costing. Every one of these will result in a different cost per unit or a different cost per hour. And I'm going to walk you through some examples of how this happens. So I also ran across this. I had to laugh. The F-16 had a unit cost of $18.8 million to the military in 1998, but the operational cost per flight hour has been estimated anywhere between 7 to 22,000 or 24,000, depending on the calculation method. So, I mean, obviously, if we choose different cost accounting methods, we're going to get radically different numbers. How does this help plan our operations, plan our capacity? And the other big problem with cost accounting, folks, is people use it to price. How do I price this? Do I price it at 8,000? Do I price it at 23? Price has nothing to do with a business's costs. You know, that needs to be shattered once and for all. And if you need to have that shattered, the webinar I did last year for AccountantsWorld last December talked about value pricing. And value pricing has nothing to do with cost. It all starts with the customer, not your firm's or your business's internal cost. So this led to Lee Segall's law, which Lee quotes in his first book, which I absolutely love. A man with one watch knows what time it is. A man with two watches is never quite sure. And since different accounting methods can throw off different results, we're never quite sure what the cost is, right? And that can lead to a whole host of really poor business decisions. So let me give you a thought experiment on this. Let's just take the Apple Pencil, the one that comes with their iPad Pro. And let's just say that the cost of this pencil is $25. Now, that could be an average of all the different cost accounting methods, but for the sake of this thought experiment, let's just take that as a given. What does this cost tell you? What does it really tell you? Does that mean that when Apple makes one more pencil, they'll actually spend $25 in cash out of their bank account? Does it mean that when they produce one less, they'll save $25? Does it mean that if Apple made 4 billion of these to get the unit cost down, you know, that idea that we can drop the unit cost by producing more, you know, because of economies of scale, we're spreading the fixed cost over a larger volume. Now, I want to come back to that point because it's kind of absurd if you think about it, but we'll get to that in a minute. But what if demand is only for 1 billion of these and they made 4 billion because they were focusing on the cost per to get that down to keep their margins up? But what if the demand's only for 1 billion? A higher gross margin will be calculated per pencil sold, but total cash costs will be higher. And my example here is General Motors. This is why General Motors is just in dire straits. One of the reasons is because they have such a cost accounting mentality that they try and get the unit cost per car down as low as they can. And what ends up happening when you focus like that is you produce too many cars that outstrip demand. There's a great book on this called Car Guys versus Bean Counters by Bob Lutz, who used to be vice president of General Motors. And he explains this in grave detail. And it's another argument against cost accounting. Now, it's not the only problem within GM. They have a lot of other problems, but this is a big one because their focus is on the wrong thing. This idea that economies of scale, you know, when you produce more units with the same capacity, yes, you're being more efficient, but you're not necessarily saving cash. Just stop and think about this for a minute. Cost accounting leads you to believe that if we make 5 million cars, say over a million, that our unit cost per car is less because of economies of scale, because of spreading fixed costs over a larger volume. Okay. And by that ratio, by that calculation, that's true. But can anybody seriously out there believe that making 5 million cars is cheaper than making 1 million? You're going to have to buy 4 million times more, you know, parts, tires, steel. I mean, it's ludicrous, some of the decisions that this path leads you down. If you really start to go down this cost accounting road, you just get totally separated from reality of cash, which is which is Dr. Lee's point that these allocated costs have nothing to do with cash. So let me give you another thought experiment. Let's just say you wrote a book and you're going to sell this book for $15 because that's kind of the price that you've determined this book is worth, whatever. And you can have 10,000 books printed that will cost you 10,000. Now we're talking a paperback or hardcover book. So that's obviously a buck a book according to cost accounting, right? It's going to cost us $10,000 to produce 10,000 books. Okay, that's simple. That means our gross margin is $14. But let's say there's a digital print option where you can get 5,000 books for $8,000. Now, when you tell your customer this, they'll say, well, that will cost me $1.60 a book. That'll kill our profit margin. I'm better off at the buck a book, right? Well, but what if the demand for the book is only 5,000 units? Let's say you only sell 5,000. So take a look at your different options here. You could have option one, where yes, you have a higher gross margin per book, but but your cash is less. I'd rather be in option two, even though the gross margin looks larger, the cost per book looks higher. In other words, don't let calculated unit cost influence your operations. And I know this is a simple example and deliberately so, but okay, let's add 6 zeros to this. And now we're talking about General Motors, right? Or add 3 zeros to it. And you're talking about a lot of different businesses. These are real decisions in the real world that have significant impact on cash. And cost accounting leads inexplicably to the wrong decisions in these examples and many others. Now, I know, what we need to do instead, and that's what we're going to talk about next, is model cash flow, not accounting calculations. But just to bring this down to possibly a more personal level, and I realize we probably have some business owners on the line that have never worked in a public accounting firm, but I'm going to assume that a good chunk of you, except for the 23% not in public accounting, probably a good chunk of you have worked in public accounting somewhere at the start of your career, and you filled out a timesheet. And the reason for the timesheet, of course, is we use it to price as a profession, which is a grave mistake, but put that aside. That you can go back to last year's webinar to hear that. The biggest defense for the timesheet is we need to figure out the cost per job, cost per client, cost per hour to know that we're making a profit. And we think that timesheets do that. And let me show you, and this is just, and you can extrapolate this to any form of cost accounting in any type of business. I don't care if it's a contractor. I don't care if it's General Motors, Toyota. It's because it's all the same principle. I'll show you why timesheets are terrible cost accountants. First off, they include profit. If you tell me that your hourly rate is $200 per hour, and then you say, I've got 10 hours into this job, so obviously it's cost us $2,000. I'll say, really? It's cost you $2,000? Who'd you write that check to? I mean, that's obviously first an allocation. Most of the time, because 63% of your salaries are your largest fixed costs, according to poll number 2, it's obvious that what you pay your people and how they are utilized are two totally different things. Your cost, that $200 per hour, includes profit. It has nothing to do with the firm's costs. Nothing. The other thing is there's no relation to the firm's actual costs, and nobody ever ties out those numbers. And the other thing you have to consider when you're looking at cost per hour in any type of professional firm is, are we really attempting to run a profit and loss on every single hour? In an interdependent system, it'd be like taking your blood pressure every 10 seconds or measuring your weight if you were on a diet, every 3 minutes. It's kind of crazy, because parts of the system are going to be less efficient, and they need to be in order for the whole to be more effective. It does not account for the lifetime value of the customer. It can't answer the pricer's most important question, which is how much money did we leave on the table today? In other words, what price could we have charged versus what we did charge? And that question, cost accounting in general, cannot answer. It takes as a given that time equals cost, that we're paying for our employees' time, but we're not paying for our employees' time any more than your customers are paying you for your time if you're a practicing CPA. Time is nothing but a constraint. Apple is subject to the same time constraints that you and I are. So is Bill Gates. So is every living thing on the planet. Time is kind of like gravity. It's just a constant, right? It's a constraint. And it doesn't help us manage anything other than to view it as a constraint. It's certainly not a cost. You're not paying your people for their time. You're paying them for the results that they can produce for your business. The other thing is different answers depending on different costing models used, as we already discussed. And by the way, volume. Cost accounting is very, very sensitive to volume, and I've got an example that will illustrate that. One of the arguments that I hear all the time for keeping timesheets is we have to know our opportunity cost. The reason the $200 includes profit is because we have an opportunity cost of our time, and that's true. Opportunity cost is an economic concept. It is not a cost accounting concept. Cost accounting is silent with respect to opportunity cost. Cost accounting is simply a way to allocate costs from a bucket to various things. This has nothing to say about opportunity cost. But here's the point. Opportunity cost needs to be analyzed upon intake of an opportunity, like say a client engagement, not after the fact. Cost accounting comes after the fact. At that point, you are not analyzing an opportunity cost. You are analyzing a sunk cost. And that's completely useless at that point because there's nothing you can do to change a sunk cost. So when I hear firms defend the timesheet by saying, oh, but we have to know our opportunity cost, it's like, yes, you do, but you have to know it before you take on the work. In other words, can we price this at a price that's so good that we know we're going to generate a profit, and we're going to keep, we're going to be happy with that? Because if the answer to that is no, then you shouldn't take on the work. But that analysis needs to be done up front, not after the fact. And the other thing, and Goldratt made this point beautifully in some of his work and certainly some of his lectures, is services and products, for that matter, and customers of professional firms don't have costs. Your clients don't come to you with a cost attached to them. Organizations have costs. Clients and products and services do not. Those are mythical creations from cost accounting because we assign costs to a product as it moves through the factory or as a cake is being baked or whatever it might be. But that's completely arbitrary. And keep in mind that the customer doesn't buy a bundle of assigned costs. They buy a finished product or a finished service. And the price they're willing to pay for that has nothing to do with your firm's internal costs. And the last thing is timesheets don't improve future performance. So that's why we need after action reviews, and this is the human learning curve. So let me give you a thought experiment that
Hey, Ron,
might illustrate this. Yes.
Could I jump in for a second with a question
Sure.
that was asked? So Craig asked, of course, you can't take cost accounting as an absolute, but I think it serves as a valuable tool in understanding operations and where problems may lie. The analyst simply needs to assess the information that they're seeing. Thoughts on that?
Yeah, I don't. I don't agree. I used to think that, but it's like, three friends are in New York and they're lost, and one says, "Hey, great, I have a map. Don't worry," and the other friend says, "Yeah, but it's a map of Los Angeles," and the friend with the map says, "Yeah, but it's better than nothing." It's not better than nothing. It'll probably get you killed. We consider cost accounting as gospel. We take it like it's an absolute, and it's not. It's completely arbitrary. And although I wish I could spend more time on this question because it's a really good point and a really great question, I'm going to strongly urge that you read Reginald Lee's newest book, Strategic Cost Transformation. In the second PDF and the downloads along with this presentation, you'll see a flyer where you can get a 25% discount directly from the publisher for both of his books. But if you're only going to read one, I would suggest you get his latest, which is Strategic Cost Transformation. And I think that'll answer this question in more detail. So let me give you another thought experiment. Let's say you're running a firm, and let's just say I'm going to make this as simple as possible. You're just a sole proprietor, and what is it? 42% of you are sole proprietors. And let's say you have a $100,000 overhead. That could be your rent. Maybe you have a receptionist. Maybe you have some technology that you spend, your fixed costs, whatever. You think you're going to work 3,000 hours in the coming year. That's how long you're going to be at the office and work, and that includes everything. I mean, admin and all the other things a firm owner has to do. But only about 1,500 of those are going to be billable, right? And that's usually about the range. You get 50, 60, 70% roughly of the time that you spend at the office actually translates into billable and collectible time. So let's say now, first off, we're confronted with the first problem. Do we divide the 100 grand by 1,500 hours of billable time, or by the 3,000 hours that you're going to work? Because notice that depending on what we divide it by, we get a radically different number, right? But let's stick with the theory of the billable hour and divide it by the 1,500. Notice there's no profit in the 100,000 because that's opportunity cost and has nothing to do with cost accounting. Notice that we're dividing it by the amount that we actually think we're going to bill and get paid for, 1,500. So let's say that you complete your work, you complete all 1,500 hours by November 30th, and you're done for the year, and you're looking forward to your month off in December and just kicking back. Well, then a new client walks into your office on December 1st and hands you a project that's about 100 hours you estimate of your time. So now your actual hourly rate allocated is $62.50, not $67. Notice this $5 difference or whatever, $4 and whatever, is highly sensitive to the volume of work that you do. Now I want you to take this little thought experiment and apply it to a firm like PricewaterhouseCoopers or one of the big four or one of the top 100 who have clients coming and going, who have people lying on their timesheet, who have people fudging and borrowing time and eating time and all the other problems with that measurement, or that metric, I should say, because it's completely contrived. And tell me how accurate that per hour cost is, even if it's done just simply on GL costs, has nothing to do with profit. It's still completely arbitrary, and it doesn't help us improve. There's so many arbitrary assumptions that this has nothing to do with the operations of the CPA firm. So this goes back to the question that it can point out problems in our operations. No, it can't. How does this point the problems to your operations? How does this help you plan capacity? How does it help you know how work is flowing through the firm? It's silent with respect to all of that, and it's just completely arbitrary. So what replaces cost accounting? First off, a business model change. Second off, value-based pricing. Appointing a value counsel and a chief value officer, a group that's in charge of customer value. And this is basically what Toyota is pretty masterful at doing. Before they even build a car, before they spend a penny on it, they know what the perception of value is in the hearts and minds and souls of their customers, and that determines the price. And then Toyota is now constricted to build that car underneath that price to turn a profit that it can live with. And then capacity and cash flow modeling, right? What Dr. Lee calls unifying finance, accounting, and operations. And this is very well explained in his latest book, Strategic Cost Transformation. And no, I don't have a financial interest in plugging that book. It's such a good book. I think it's incredibly dynamic, and I just highly recommend it. The other thing is project management. A lot of firms don't do a great job with project management, and project management has nothing to do with looking at timesheets historically. I always say that if you're running a firm based on timesheets, it's like timing your cookies with your smoke alarm, because by the time you see problems, and this is true with cost accounting, by the way, by the time you see problems, it's already too late. The damage has already been done. This was another point that Goldratt pointed out in the goal and the theory of constraints. You got to find the bottlenecks is in the operation. The accounting's only going to reflect it after the fact, and maybe way too far after the fact. That's why the joke about accountants, we kind of come in after the war and bayonet the wounded. But that, we're historians with lousy memories, but that doesn't help operations at all. The other thing I think we need is key predictive indicators, conducting after action reviews, and systems thinking. Now, again, folks, I can't do any one of these topics any justice in a 1-hour program. I'm just giving you the complete list of other disciplines and other forms of thinking that you need to think about that replace cost accounting. Because again, this isn't obviously a multidisciplinary function. I mean, cost accounting, gathers data from all sorts of different places, but there's better ways to think about some of these things, and there's better processes and better systems out there, especially for knowledge firms. And the first is capacity planning. I mean, I coined this law many years ago, but that bad customers drive out good customers. But any business is got a fixed capacity. And I don't mean, how many hours you can bill. I mean how many customers you can take care of uh, at a at a great level of service. And this is a model of or schematic of a 777 Boeing. But think about how the airlines or a hotel or a cruise ship, how they divide up capacity and how they use price to kind of manage that. You have the discount seats, you have the full fare coach, you have the business class and first class, and firms have the same capacity to divide up their capacity to different customer segments, and only not to expand capacity for the back of the plane customers. I mean, right? No airline's gonna expand capacity for the back of the plane. They'll expand capacity all day for the front of the plane, but not the back of the plane. And there's all sorts of ways to model a firm or a business's capacity. This is something else that Dr. Lee gets into. Just to touch on KPIs, and this is going to be very brief discussion, but since I mentioned it, I feel I need to address it. I'm going to give you another thought experiment. Let's say you're CEO of United Airlines. You're watching this Dreamliner take off, and you ask yourself a pretty interesting question. What's going to predict whether or not those customers on that plane right there taking off are going to come back and fly with United? Now, somebody last week said, well, they bought a round trip ticket. Okay, but beyond round trip ticket, what's going to predict that? Well, I will tell you what will not predict that. Accounting data. Any type of cost accounting data is not going to predict that. In other words, we need leading indicators that determine and can predict and be predictive of the future. So what's really going to predict, at least in the airline world, is on-time arrival, not losing your luggage, and if the customer complains, did we fix the customer and fix the underlying problem so it doesn't happen again? And those are the 3 KPIs that drive the performance, the financial performance of airlines. And this is well established with decades of data and causation and correlation and all of that. But we know that if an airline blows it on time arrival, that customers are going to defect, especially business customers, because they have to make connections and make meetings and all of that. And indeed, that's what we've seen in the history of the airline industry, is why Southwest is so good, because they've got an impeccable on time record. And notice that those 3 KPIs, lost luggage on time and customer complaints, don't show up on an income statement, and yet they predict whether that income statement is going to be red or black on the bottom line. And that's the kind of leading indicator, the kind of canary in the coal mine that we need, because this idea that what you measure, you can manage, which is usually attributed, by the way, to Peter Drucker, and he never said it. It was actually said by the founder of McKinsey. And it's not true. You don't make sheep any fatter by weighing them. You have to look at the underlying process, right? You don't become a better golfer just by keeping more accurate score. I'm not saying you don't have to keep score or you don't have to weigh yourself if you're on a diet. Of course you do. But if that's all you did, that's not going to help you manage your weight or manage your golf game. You have to look at the process. You have to look at your diet, your exercise regimen. You have to look at your swing if we're talking about golf or tennis or whatever. Just looking at the measurement is only looking at the result. It's not looking at the cause. And again, this is Dr. Lee's point. It's Johnson's point. It's Goldrat's point. And they make it very persuasively, because remember that data it is only available about the past. Data by definition is about the past, but the only way to peer into the future is to have a theory. And a theory is not necessarily driven by the measurement. Our theories determine what we measure, not the other way around. It's the theory that tells us what to measure. And that's what's really critical, because every entrepreneurial launch is a theory, right? Steve Jobs had no idea that the iPhone was going to take off. It was a bet. It's a theory, if you will. And if it would have failed, he would have lost a lot of money. Apple would have lost a lot of money, but they would have learned something. But we only have data about the past, and the past is not predictive of the future, unless your theory is the future is going to be the past plus 10%, which is kind of an insane theory, because anything new or innovative or creative by definition takes us by surprise. Um, so that's what I mean by KPIs, key predictive indicators, and just to think about why do we measure, and if we're trying to change something, like for instance, if you're trying to change your business model, not only do you need to change your pricing, but you need to change what you measure. I can think of no business model change in enterprise history that doesn't have two components: a pricing change. So we go from buying $20 CDs to buying $1 a song, or now streaming music on Pandora, Spotify, whatever. That's a pricing change, right? And also the second change is what's measured inside of a business changes. So Airbnb is not measuring the same things that hotels are. Their dashboard looks completely different. Their KPIs are completely different. Same with Uber, same with any other business model that you can come up with. The internal measurements change as well. So if the CPA profession is talking and paying all this lip service to changing its business model, until it changes its metrics, it's really not changing the business model. That's why you have to get rid of the timesheet if you want to implement value pricing, because you got to change what's measured. You can't measure value pricing with cost accounting and timesheets. You can't do it. It's completely ineffective. And just to give you an example of this, if you're a baseball aficionado, and I am not, but you've probably heard about sabermetrics and Bill James. Bill James, a Harvard-educated economist, changed what baseball measured. And this is the story of Moneyball, right? The book and the movie with Brad Pitt. And this is what got Boston Red Sox and the Chicago Cubs. I mean, Theo Epstein was a disciple of Bill James. My colleague Ed Kless, who is a baseball nut, thinks that Theo Epstein belongs in the Baseball Hall of Fame because he applied sabermetrics to these two teams and took them to the World Series. Something they hadn't done in a long time. And that just shows you the power of what we measure. If what we're measuring is a true theory, it can really drive results. And remember that a key predictive indicator, as opposed to a performance indicator, is defines success the same way the customer does. So my favorite KPIs for professional firms are turnaround time, just like in the airlines, HSDs, high satisfaction days, when you or your team have a great day, because you came through for a client, or they sent you a thank you card, and the value gap, which is what we charge the customer versus what we could be doing for the customer, and the price of all that we could be doing for the customer, because we think they truly need these additional services. Maybe they need estate planning or financial planning, retirement planning, whatever it might be. And the other one is the Net Promoter Score. A lot of firms out there are using the Net Promoter Score. It can be predictive of customer loyalty. I've seen it work. I've seen it fail. It's a theory. It needs to be constantly tested. It may or may not. All of these four may or may not be predictive of your particular business's success. The last one I really like is innovation revenue, the value to the customer of the firm, rather than the lifetime value of the customer to the firm. It kind of turns the telescope around. It also measures what percentage of our revenue comes from services that we didn't offer 3 years ago. And with that, Dale, I'll take you to the last poll question.
Sounds great. So I'll go ahead and launch that right now. And in this one, you can select one or more of the following. So which KPIs do you currently measure or plan to measure in the next year? And somebody wrote in, if you could just briefly re-explain high satisfaction days and the value gap.
Yeah, high satisfaction day is when you or your team have a day where you just pump your fists and go, yes, this is why I'm alive. Maybe it was a breakthrough on a client. Maybe you got a no change IRS audit. Maybe a client came in, hugged you, and gave you a bouquet of roses because you helped them through a difficult, divorce or difficult time in their life, or just some day where you just go, this is why I was born to do what I do. Just the days you just pump your fist, and that's an HSD. And the more you see of those, the higher the morale of a firm, the more we know it's inculcating its values and living its purpose and delighting its customers, and the more predictive it is of financial results.
Great. And then value gap?
And the value gap is the difference between what you're currently receiving from the customer, so the revenue from the customer, versus what you could be receiving from the customer if you provided all the services that your firm is capable of doing that you think they need. Now, I'm not talking about cross-selling. I'm talking about adding more value to your customer. They just had a child, so they need, college planning, or they need to update their will or estate plan, whatever it might be. Your firm can offer all these different services, perhaps, but you're not currently. You're only doing the compliance work for them or whatever, and it just forces you to go out and have conversations with customers to close that gap.
All right. So folks, we'll give about 10 more seconds here, so please go ahead and get in your vote if you haven't already done so. I see most of you have, but we'll give a few seconds here for folks who are struggling.
And Dave, I know I'm going to run out of time here, so I'm happy to go a little bit over, folks. If you indulge me, I will finish this presentation, but we may run a little bit over the top of the hour.
All right, so I'm going to go ahead and close the poll here, and I'll go ahead and send it back to you. We had an even split basically between turnaround time and the value gap, a little bit lower for high satisfaction days.
Excellent. All right, so let's talk about the other thing that kind of replaces cost accounting. And this is not, this has nothing to do with financial accounting. This has to do with learning and capturing knowledge so we can actually improve future performance. And that's an idea from the United States military, specifically the Army, but all branches of the service use this. In fact, all around the world they use this, though they may call it different things. I'm just calling it after action review because that's what the Army calls it. There's 4 questions in an after action review. So you go out and you do a mission or an engagement, an audit, a tax work, some type of mission, as the Army would say, and then you come back. And there's actually a structured agenda for an after action review. And there's 4 questions, essentially. What was supposed to happen on this mission? What were the objectives? And you'll find that when you do this, a lot of people don't know, which is kind of like the first learning is, hey, we need to get clear on what the objectives are before we go out and do something, right? Like the Blue Angels say, they always know why they're going wheels up. They always know why they're flying, right? Every time they get in the aircraft. What actually happened out there, right? We have plans, but then, as Mike Tyson said, everybody's got a plan until they're punched in the face. So what was the ground truth? And then what were the positive and negative factors between what was supposed to happen and what actually happened? Because there was probably some good things that came out of that difference, and there was probably some bad things. What were they? And then what have we learned, and how can we do it better next time? The Army has a pretty structured agenda for this. I've got one. You can email me, or you can find it on our show notes at thesoulofenterprise.com. We've done a couple different shows on after action reviews, and you can find all of those on our archive page at thesoulofenterprise.com. And you'll find in there a PDF of an after action review agenda. But these are the 4 questions. You're not supposed to take longer than 50 minutes. And it's now so ingrained in the culture of the military. I mean, they do AARs for everything. You can see them doing AARs all the time, even sometimes in the middle of a mission when the enemy did something that they completely unexpected. Now, I mean, obviously, they wouldn't hang around 50 minutes, but they might just do a quick regrouping and talk about, okay, let's change our objectives because this happened. And I just want to make the point that, here's my new friend, Chris, a former United States Air Force Thunderbird, ejecting from his F-16 at a live air show in Idaho, 40 feet above the ground, half a second from impact, after a 25.5-second wheels up flight. He said it felt like 3 hours because of temporal distortion. His spine compressed 2.5 inches when he ejected because of the force of the seat. He came down, he landed in the fireball that was the crash, and he got up and he walked away. And what he said about this was, the only reason I'm alive is because of the after action review, because we train for this. We know what to do in this situation. So it didn't feel like it was brand new. He knew, this scenario, and he played it out. He says, so how does the military take a young college graduate and turn them into a fighter pilot using the debrief, which is what the United States Air Force calls the after action review? Same thing though. And the resulting lessons learned and experience, he calls the AAR, an experiential learning accelerator. And just he makes this point too, because now he works for a company called Afterburner, and Afterburner helps corporate America, corporations around the world, I think, uh, implement the debrief and the lessons learned. And he says, the Thunderbirds have a 50% turnover every 2 years. There's 6 pilots, and 50% of them turn over every 2 years. After 4 months, they're able to go out and do an air show and do stunts like this. How does that happen? He points out that in many companies and many firms, groups have been together for decades and they can nowhere near achieve this level of performance. And one of the reasons is because they're just constantly doing, they're not stepping back and taking the time to reflect on the lessons that they learned. And he says only 33% of organizational objectives are achieved, which is an incredible waste of talent, money, everything else, if you just learn from the school of hard knocks, because we all do after action reviews around the water cooler, driving back from the sales meeting in the car, you talk about the experience, what went right, what went wrong, what should you have said, all of those. Well, that will get you a 5% improvement. But if you use an unstructured AAR, you'll get 28%. And if you use a structured AAR, you'll get a 38% increase in performance. And Chris claims with a competent facilitator, you'll get a 300% performance. Now, look, I'm not sure about that one, but what I do know is if you do use a structured AR process, you will increase future performance. And let me just say this about that. If you do after action reviews, you no longer have to do timesheets and you no longer have to do annual performance appraisals, because both of those systems do not improve future performance. AARs actually improve future performance. They actually do improve future performance. Timesheets and annual performance reviews do not. There's no evidence in the literature that annual performance appraisals, for example, increase future performance. They don't. This is why so many companies, something like 12% of the Fortune 500 now, have ditched annual performance appraisals, including, Accenture and Deloitte and Adobe. And I mean, I could go down the list. It's quite a who's who of companies that have ditched the annual performance appraisal. It's just kabuki theater. It's just a waste of time, waste of resources, and it doesn't improve. It doesn't set out to do what it's supposed to do, which is increase future performance. So Chris also points out that it's not just debriefing; it's a real culture of debriefing. In other words, it's a real management innovation. These after action reviews, debriefing, whatever you want to call them. And they really do increase future performance. The last thing I've already made this point. The last big idea I want to throw at you that's an integral part of this is just systems thinking. And systems thinking is a system is a whole that cannot be divided into independent parts. Its properties and behavior derive from the interactions of its parts, not their actions considered separately. A disassembled auto cannot carry people. And this comes from Russell Ackoff, who is a great systems thinker. He's written some books on it. If you tried to build a world-class automobile by taking the engine of a Ferrari and the brakes of a Porsche and all these other world-class parts from all these world-class cars, you wouldn't have a world-class automobile. You'd have an expensive pile of junk, because each one of these cars is an interdependent system, right? And parts, Porsche might have world-class brakes, but some other part in a Porsche may be less than world-class, but the whole still works very, very effectively. And you just can't divide things up. Just like a surgeon sometimes has to cut off a body part or take out an organ to make you healthier overall. It's an interdependent system. And that's really the problem with cost accounting, is it atomizes and cuts everything up. And then it does something even worse. It does allocations. If you want to learn more about systems thinking, I recommend this book, The Fifth Discipline. It goes deep. It lays out 11 laws of system thinking. It's kind of a tough read. It's not a beach read. I warn you, this is a brutal book to get through, but the 11 laws are really good. We also did a show on this on the Soul of Enterprise. These are the 4 books again, and the second PDF is this. This is the flyer from Reginald's new book. It literally just came out. You can get a 25% discount off of it if you use this code in red here. And you can also get his other book, his first book, Lies, Damn Lies, and Cost Accounting, for 25% off as well. So you can get both of them or just one of them. If you're only going to read one of them, please read Strategic Cost Transformation, because he goes into more detail about cash modeling, capacity modeling. Because really what we're doing here, folks, is we're modeling cash flow. Stop worrying about cost accounting and model cash flow. Cash is king. And one great thing is CPAs already know how to do that. You already know how to model cash flow. This is how you can find me, Twitter at Ronald Baker. But the most important thing is the soulofenterprise.com. You can find all of our shows. We do a live radio show every Friday, and you can find all of our shows. You can listen to it on demand. You can get it on iTunes, Stitcher, Google Play, wherever you manage your podcasts. But we've interviewed Dr. Reginald Lee twice. We've done shows on cost accounting. We've done shows on after action reviews. We've interviewed Chris Strickland from the former Thunderbird who ejected twice. He's been on the show talking about after action review processes. So you can find all of that. Just Google search right on the soulofenterprise.com page, and you can find all those shows. And if you need any help or you want additional information, reach out to me. Here's my email. Here's my phone number. I'm happy to continue this conversation. Again, I didn't plan to convert you today. That's not my goal. I just want you to think with me about this topic. I hope I've put a chink in some of your cost accounting armor, like it happened to me all those years ago. And good luck with this. So thank you very much. And thanks for Accountants World for running this program.
Sounds great. Well, thank you so much, Ron. We've gotten a lot of great feedback. Amy and Tracy and Reginald all writing in here in the questions and mentioning how much they've enjoyed this presentation today. So thanks to all of you for joining us. Thank you again to Ron for your time today and for really thought-provoking talk. And as you mentioned, this is just the start of that conversation and learning. So you've got some more resources there. We'll include that in the follow-up email as well, so you can continue to learn more on this. Last thing I wanted to mention, thanks from Accountants World and from myself for all of you who've joined us this year for our expert webinars. This is the 16th and final one this year. But any of those that you have missed or any that you'd like to revisit, including Ron's, you can go to 2018webinars.com, 2018webinars.com, all one phrase, no dashes or anything in there, and you'll be able to view all of this year's expert webinars on demand. You just let us know who you are, and you can go ahead and view as many of those on demand as you'd like to, of course, at no cost at all. So thank you again to Ron for your time today and for your insights. Thanks to all of you for joining us. And have a great holiday season if we don't talk to you before then. And be well.